Okay, and today main focus for this particular webinar, what we'll be talking and sharing about is on the dividend growth portfolio. Okay, and this is something that I personally feel is a very good opportunity right now, simply because the market has, the stock market, right, has basically made a very big correction. Okay, and that's where a lot of companies' prices in terms of stock market has also fallen, and that present us with some good opportunities within this few period to kind of scout for good companies to invest in and build up our portfolio in terms of stock investment. Okay, so now we'll get started straight away, because today's webinar, there's many content that I'd like to share with you. Okay, and basically we might usually I'd like to keep webinars between 45 minutes to an hour, or maybe even about an hour-ish. Okay, but looking at the content that I prepared for you guys, today we might extend it a little bit, maybe 1.5 hours to 1 hour 45 minutes. Okay, so again, just like to get you guys prepared. Okay, and today the focus here is basically 5 things that I want to share with you. Okay, and these are the 5 steps to build a dividend portfolio. Number 1, of course, we will go into details of it. Okay, but number 1 is definitely we need to determine our goals and target. I'll share with you my personal one. Okay, but all of us are very different. Okay, so you definitely need to spend some time to really determine and identify your goals and target with respect to investment, right? Which is what we're going to focus on today. Okay, then of course the next step is, once you have a clear goal and target, that's where you do your research. Okay, and what I would like to share with you is most of the research, I would say 90% of the research I've already done for you, and I will be including, you guys can download a toolkit, okay, right after this particular session, and almost everything, 90% is done for you. Okay, the remaining 10% is something that you need to still do a little bit of work, simply because all of us are very different in profile, in risk appetite, in our investing philosophy, right? And that's where your 10% come in, because you need to identify it for yourself. Okay, and then today we'll spend some time to talk about allocation of asset. This is important in investing, okay, because you need to understand, if you have a pool of capital, how are you going to deploy them, right? How are you going to allocate that capital into the different sectors, different portfolios, etc., right? So we'll talk about it, and we'll talk about strategies of managing it, and how you can grow your account. Okay, and then last but not least, of course, everyone starts small, but we all want to finish big. Okay, and this is in terms of the mentality of a dividend investor, okay, that I'll spend some time to talk about at the end of this webinar. And over here, okay, today's sharing session, I'll share with you how you can really understand these 3 categories of portfolio. Okay, so definitely majority of it will be put under dividend growth. That means most of the time today we spend sharing and discussing with you guys about dividend growth. Okay, but I also like to talk a little bit about all-weather portfolio, and a very short one on momentum trades. Okay, because of different profile, your allocation of your portfolio will be slightly different from these 3 as well. Okay, so we'll definitely talk about all 3, okay, but the focus is on dividend growth for today. Okay, basically it's a Google spreadsheet, right, that I've actually worked out for all of you. Now today I wouldn't want to spend too much time to go into details of how to use this spreadsheet. Okay, I'll probably record another video to guide you for the main purpose, to guide you how to use this particular toolkit. But today I'll just like to show you that almost everything is done for you within this toolkit. Okay, so over here, okay, I want you to look at this part first. All right, so this is the dashboard. Okay, so this dashboard over here, you can see that we start off with initial investment equity. Okay, so I actually put in some figures to just show you how it works. Let's say you start with $10,000 US. Okay, and of course, if you just started, this is your current equity as well, and this is where you can choose your investor profile. Okay, and you can see right now it's set to aggressive. Okay, but basically when this is set to aggressive, your portfolio allocation is that you're not gonna invest into the all-weather portfolio, but your allocation will be 50% goes to dividend growth, okay, which means half of your capital will be used to invest into the dividend growth portfolio, and then half of the capital will be invested into the momentum trades portfolio. Okay, and of course, this is just an illustration of the charts. And of course, if you are conservative, then you wouldn't have any capital allocate to momentum trades, because conservative means that you would prefer a much lower drawdown, much lower volatility, and in return, you don't mind a modest profit. Okay, so that's what conservative really means, all right? And of course, if you're balanced, then 40% of the capital goes to all-weather portfolio, 40% goes to dividend, okay, and the remaining 20% of the capital goes into momentum trades. Once you've done that, once you have a clear understanding about your profile, are you balanced, aggressive, or conservative, and you already know your goal, okay, then that's where this part comes in, is where you need to do a little bit of research and understanding, which tunes into your profile as well, right? Your investment journey. Okay, so today we're going to talk about this three, okay, all-weather, dividend growth, and momentum trades. Now, while I've done most of the work for you, I need you to also at least have a basic knowledge and understanding about what this tree profile is, okay, so that you don't go in blindly and then you just follow whatever I say in this webinar. Now, why I say that the all-weather portfolio is actually very ideal for investors who are very conservative, okay, because I just want you to know that if today you are conservative, right, you need to also acknowledge that you cannot aim for too much of a return, because in the world of trading and investing, always a balance between risk and return. Okay, so I want you to see, just to share with you, right, this is the all-weather portfolio performance statistics. Okay, so you can see here, max means all the way back to January 2007. Okay, so 2007 until today, 2020, somewhere about 12 to 13 years, right? The average annualized return is about 6.9%. Okay, but the worst drawdown is only 12%. Okay, this includes the subprime mortgage, which is 2008, right? We know US subprime mortgage, right, where the stock market tanked. But this portfolio, you can see, yes, it also gets affected, but the loss of it is only 12%. Okay, so the volatility of it definitely is quite controlled. Okay, and you can see this is the year to date. Okay, which means that from January 2020 until this one here is last updated is end of March. Okay, while the stock market tanked, right, everyone was quite scary, was quite scared, fearful. You can see that this all-weather portfolio, it only drops by 2.3. Okay, and that's like nothing, right? If your portfolio drops by 2%, it is really nothing. Okay, and you can see up to today is actually making, if you invested in this portfolio in January, okay, at least right now you're still making money as of end of March time. Okay, now, so this is where the main bulk of the opportunity I feel right now in the market comes from, is really on dividend growth. Okay, so to make it very simple, what does dividend growth means is that we want to invest into company, or basically investing in a company, right? It's just like you want to buy a small portion of company, right? So for example, when we say we invest in Apple, simply means that I want to be a stakeholder, or I want to like own a mini part of Apple company. Okay, and that's what it means by investing in companies. And when you invest in companies, right, when companies make money, they pay you bonuses at the end of the year. Okay, and that is what we call dividend. Okay, so what we want to focus on, you realize there's two things. One is dividend, one is growth. Okay, so on top of just looking out for companies that pay you regular, consistent, dividend or bonus at the end of the year, you want it to be increasing as well, which means you want this dividend to increase year on year. Okay, so for example, if today, okay, the company pays you, for example, let's say $100 a year, okay, in dividend, then you want it to increase to by next year, maybe it pays you $110, right? So that's a 10% increase in dividend. So what we want to focus on is not just company that pay dividend, but they are paying a growing dividend to us. Okay, and that's what I mean by dividend growth. Okay, under the tab here, bottom, you can see dividend list. Okay, if you click into it, this is where you get the 49 list of companies that have shortlisted. Okay, and these companies is all on US market. Okay, so there's a reason why I focus on US, because the capitalization of it, the market cap in US is the biggest, right, in stock. Okay, so these 49 companies are all in the US. Okay, so you can see the ticker, the name, right, the current price. Again, all these are auto updated. I've already coded in some formulas, which means that this price here is already updated, which means when the stock market is open, okay, it'll get updated based on the most current price. And of course, PE, EPS, yearly dividend, all these are auto updated. Okay, and you can see over here that is the industry and sector as well. Okay, this too we'll come back and discuss about it. Yeah, so let's come back to this part where, you know, a very common question that many people ask is, what price should I enter? Okay, so this one I want to share with you that there are many different models of valuation. Okay, and there's no one best model. Okay, and to me, okay, the key is to keep it simple, because my approach that I want to share with you towards investing is we are not looking for just capital gain. Okay, so if we are trading it, then yes, which price you enter is very important, just like how we trade the currency world. Where we enter, where we put our stop, where we put our take profit is key. Okay, because that's how we make money, right? But if you are investing for the longer term, then exact price of where to enter is not that crucial, right? But the fact is, keep it simple. Okay, and last webinar we talked about macro analysis, right? Where, you know, people always focus on price, PE, valuation, and things like that. I want to just, you know, do a very quick recap. Okay, we talked about this during last webinar. Okay, some of you probably haven't seen it, right? The recording is up, watch it. Right, if you remember last week when we had the webinar, I actually have this slide and asked, have you ever wondered why when a company PE already so high, yet price can keep going higher, right? And of course, the time we talk about liquidity, right? Okay, and quoting this person called Stanley, right? He mentioned that he focused on central bank and focused on movement of liquidity, and liquidity is the one that moves market. Okay, so if you really understand this quote here, okay, about liquidity and how it moved the market, okay, valuation again, it's not something that you need to get, you know, too complicated about it. Okay, because he mentioned here, right, valuation only tells me how far the market can go once the catalyst set in. Okay, so I want you to also understand that the approach towards investing, valuation is important. I'm not saying don't look at it, okay, but don't go like all focus on what is the best model to do valuation. Okay, so today I'm going to share with you that it's important to fall back to the goal and the target we want. Okay, and this part here, I'm sharing with you that I'm personally building a portfolio dividend. Okay, so again, the mindset and the philosophy in dividend is we first focus on dividend, okay, not the price gain of a particular stock. Okay, so stock prices is secondary. Okay, so it's not that we want to invest in the company and the price keep dropping and we are happy of it. No, but I'm saying that we don't focus and we don't put our main focus on price increasing in the stock that we invest in. Okay, but we want to focus on dividend. Okay, so this part here, just want to share with you that the valuation model that I'm going to share with you in this webinar, okay, together with the toolkit that I've designed for you, is mainly as a guide and reference. Okay, and it's not meant to be like, oh, good, now is the good price to enter. All right, it's not meant for that. Okay, so I want to share with you this first before we talk about the model. We'll use the example of AT&T again. Okay, let me go to the checklist. All right, so you can see over here under the toolkit, right, under dividend portfolio. Okay, if you click into it, there's this portion over here, discounted dividend calculator and discounted rate. Okay, so this is the part where you're gonna use it to kind of like calculate the intrinsic fair value. Okay, so this part here, this part that I highlighted, okay, they are automated. That means you don't touch it. Okay, there are formulas running behind it. All you have to do is just here, this part. Okay, all you have to do is this part. Okay, you need to input some data. Right now, this data here is, of course, you need to first key in what is the annual dividend payment of the company that you like to calculate. Okay, and over here, let's say we use AT&T as an example, right? So AT&T is this, you look at this. Okay, so yearly dividend is 2.08. Okay, and all you have to key in here is 2.08. Okay, and then the next thing you need to key in is expected dividend growth rate for the next 10 years. Okay, so this part here is where you can use the investing.com. Okay, you go back to financial ratios. All right, you select the company, which is AT&T, and then you go to financial ratios. You can see at the bottom, okay, the dividend growth rate, okay, is about 2.04%, right? So all you have to do is just use this as a reference to key in 2.04%. Okay, so what's the difference between dividend growth rate for the next 1 to 10 years and terminal? Okay, there's a difference if, let's say, today you expect the company to keep increasing their dividend for 2% for the next 10 years, and then terminal means that beyond 10 years, what do you expect the growth rate to be? Okay, if let's say after 10 years you expect it to be 0, then you just key in 0. Okay, if you expect that after 10 years, this company will continue to grow its dividend, right? Increase its dividend payout, but maybe at a slower rate, then maybe 1%, you key in 1%. Okay, so that's the idea of it. Okay, so let's say we just keep it as 1%, right? And discounted rate or expected rate of return, basically this is like how much do you expect to gain from this particular investment into this particular stock, which is AT&T. Okay, and this is based on yearly. Okay, so if let's say you put in some money and invest into AT&T and you expect it to give you an 8% return after a year, right? Then you put in 8% over here. If you say that, oh, I'm more ambitious, I want to expect 10%, then you key in 10%. Or you can say that, oh, I'm happy with 7%. Okay, then you put 7%. Okay, so you know, a good expectation is somewhere maybe 7 to 8% a year. Okay, so that will be pretty good. So if I key this in, you realize that everything here is automated. Okay, and this one here is where the intrinsic value is based on this valuation model. Okay, so the calculation here tells us intrinsic value is $32.44. Okay, now what this means is that if the price of AT&T today is trading at $32.44, it's fair in value. Okay, meaning it's normal. Okay, if it's below $32.44, then it's good. It's at the discount. It's like you go shopping. Okay, the usual price is $32. Right now it's trading at $28, so it's good, right? It's discount. If let's say it's trading at 36, then it's expensive. Okay, but again, use it as a reference, as a guide. Okay, so why I use AT&T? Because it's a good reference to share with you right now. If we go back to AT&T price list, right, you can see now the price is trading at $30.39, right? And based on this model that we calculated, the fair value is $32.44, right? Right now it's trading at $30. Okay, so $30 is, okay, it's this one, right, somewhere here. Okay, which means that we are at a 10% discount. Okay, so basically that's what it means, right? So right now AT&T price is undervalued, which means it's cheap, it's at a discount, maybe it's a good time to get it. Okay, so that's how we use it as a reference, right? It doesn't mean that immediately you go and buy and, you know, put a lot of money into investing in AT&T. No. Okay, so that is the reference that I want to share with you. Okay, so this calculator has been built into the tool for you guys as well. Okay, so when I talk about allocation between markets, is I'm referring to this model here by Stam-Storville's money flow model. Okay, I give you a teaser last week, right? So what this is basically the model that talks about we are in a world that the economy tends to have a cycle. Okay, and of course the cycle here is we have a very good economy, and then, you know, everything is good, and then eventually we go into a recession, and then from recession we'll eventually recover out of it. Okay, so you can see over here, this is the business cycle. Okay, and again, we have various factors to go through it, okay, but the investing toolkit has done all this for you as well. Okay, so over here, just to give you a quick one, okay, on this model. Okay, you can see we have 4 phases. Okay, these 4 phases are kind of like similar to the 4 seasons that Ray Dalio mentioned. Okay, just that it's slightly different in its own way. Okay, but you can see it as it's just the 4th season. So you have the full recession, then you know, market will go into recovery, and then full recovery, and then we'll go into recession, and then again this whole cycle repeats. Okay, and in this model, okay, within each of these seasons of this cycle, there is certain companies in a certain industry sector that is going to perform well. Okay, so for example, like early recovery, okay, industrial sector, basic industry sector, energy sector tends to perform well. Okay, that means companies that are in this sector tends to perform better. Okay, and of course, when we are in, let's say, for example, early recession, then companies that are in utilities, finance, and cyclical tends to perform better. Okay, so what are these like? What are these sectors, right? Don't worry about it also because it's again already in your toolkit. This tab here called economic cycle. Okay, economic cycle. If you click into it, right, you can see here there are a few things that's happening. Okay, so the first one is actually this part. Okay, the black color ones, okay, are basically the ones that you need to really input some data, right? The 10% of work that you need to do. Okay, the rest of it are all automated already. Okay, so over here you can see this economic cycle. There are 4 indicators that we use to determine which cycle we are in. Okay, so what I've done over here is just, these are all links. Okay, so for example, you want to look at consumer expectation, you just click onto this. Okay, it will bring you to a website, and you just need to see, right, based on this chart over here. Okay, like this is April, right? So this is previous month. You can see from 89 to 71. Okay, so that is pretty drastic. Okay, so once you've done this, then you just go back to the toolkit. Okay, and then say here, choose falling sharply, right? It's definitely not reviving, it's definitely not rising, it's not declining, it's like sudden drop. Okay, so you just pick falling sharply. All you have to do is just look at the visual perspective of things, and then you put this in, and then this part here is automated. So you realize that we are in between, okay, early recession and full recession. Okay, we are in between it. So what it means is that if you follow this model, okay, we are somewhere here. Okay, we are transiting from early recession to full recession. Okay, so we are in that transition. Okay, then what you need to do next, okay, is to understand that we are now in early recession. Okay, so you pick this. Okay, so we are in between these two, right? So you either choose early or full. Okay, so sometimes it's like that. Okay, you have 2 here, 2 here, half half. Sometimes you might have 3 and then 1, and then it becomes clearer. Okay, so let's just pick early recession. Okay, so sector to focus, these are automated again, utility, finance, cyclical. So of course, if you pick full recession, then you focus on cyclical, technology, industry. So let's just focus on early recession, utility, finance sector, and cyclical sector. Means that this 3 sector, companies in this sector tends to perform better during this period of time. Okay, you go back to the shopping list. Okay, this one here again automated. You'll be able to see that we are in early recession, and these are the sector to focus, right? So how then can we do it? Okay, on the right hand side, you can see here sector, right? And I've done in the filtering. Okay, all you have to do is just click on those that are in the sector that we want to focus on. Okay, which is utility, okay, finance, okay, and consumer cyclical, which is cyclical. Okay, then you click OK. Basically, it will filter out all the companies that are just left within these sectors. Okay, and that becomes a very quick way to kind of filter. Okay, these are the companies for now, this period, I want to be focusing on. Again, back to the question, have we seen the bottom of the stock market? Likely not. Okay, but very difficult to say. Again, go back to study the macro analysis webinar we did last week. Okay, because we use that to also understand a little bit whether the market is bottoming, whether is it ready to rally and things like that. Okay, yeah, so go back to that webinar of macro analysis to understand that portion of it. Okay, so again, don't jump into it just because you fear you miss out on the opportunity. Always make sure you understand the things that we are doing first, then only you get started, right? And if you get started, again, don't throw everything all in immediately. Okay, start small, finish big.